Welcome to the Dividend Talk Podcast, episode 250, exploring minimum starting dividend yields.
Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom and I'm joined with my co-host European DGI. If you want to learn more about us, please visit europeandgi.com where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started.
Hey, European DJI, how's your vacations going?
Oh my God. Very good, very good. But I can tell you, I'm exhausted. I have no time for anything. Flying back with an airplane at 10 p.m. in the evening and arriving at around 1 at midnight home. It's not always a pleasure. So I'm really living on the last drop of energy that I have, and I'm traveling soon for work also again, 2 weeks in a row. So it's a tough one, but by the end of July, I will have a nice jolly vacation. So we'll get there. We need to just sit through. It's a bit difficult, but you know, the dividends keep coming in. I received my legal and general dividend.
Yes, a lot of people commenting on legal in general this week.
That was a nice one. That was really a nice one. Really nice one because I bought even some more last year. So it's paying for a lot of bills this month. So that's nice.
Good. Yeah, well, I'm quite similar. I'm actually packing up and leaving tonight as well for work, so it's quite busy. So I'm looking forward to my actual vacation at the end of June, so I can relax. But it's the joys of working, I suppose. You can't complain. Traveling the world is and getting paid to do it is not much of a complaint, is it? I can't really feel too sorry for myself.
I don't like it, so I prefer to just stay home.
Yeah, me too.
I can work from home a lot or from the office, but I don't need to be abroad. But you know, this was mostly a mix. Yeah, mostly pleasure that I had over the last few weeks. And yeah, I can't complain. I really can't complain. Life is good.
Yeah, and hey, we've made it to 250.
Episode 250, right? That's damn, that's a lot. We should one time do like an all-time best or something like that. With some fragments, but maybe AI can help us because we would need to upload like 250 shows and tell us the highlights because I don't keep a track on it.
Yeah, I tried to do something on this back for when we did season 4. So after the 4th year, I tried to go back and man, it was just too hard. I gave up. I think I got through like 30 show notes. I was like, I can't do this. I just can't do this.
And in 2 weeks, we celebrate 5 years, right?
Yeah.
5 years in 2 weeks. So
5 years, crazy.
5 years of my life.
It's mad, isn't it? When you think about it, like back in 2020, maybe we did not think we'd get past 2 episodes, let alone 200, now 250. So it's...
And your dividend has been compounding nicely during that time, right?
Of course.
Do you feel like there's a correlation between you and the podcast and your dividend income?
The dividend income is probably growing quicker.
but is it because the podcast makes you learn more and therefore stay sharper on things? Or?
100%. We get like the questions we get, the companies that we're exposed to. Even just recently, I know we did a show with Dazzy Mike and we asked about companies we would not usually talk about. And I told you this, I got a list of 40 companies that I started to make my way through. Some really nice companies, I must say. One from Romania, a couple from Belgium. So you get lots of knowledge hosting a podcast because you get so many suggestions, ideas, challenged. It makes you learn, makes you grow, makes you think. So
yeah, same here. I think without the podcast, I don't know. It's easier to keep disciplined. If you're disciplined for the podcast, then it's also easier to keep disciplined for investing.
of course, and we're held accountable. So
Exactly.
also
And it's
helps.
easier sometimes to be held accountable by a third person than by yourself, because, you know, it's like sporting. If you, I don't like running. I know we have a lot of runners here, but I need to do it alone. But I was all my life playing football. So, you don't let your teammates down, whether it rains, lightning, whatever it is, you just go. Yeah.
Yeah.
But when it comes to running individually, I can easily skip an evening. I skipped already a whole year. So
I'm after skipping about 40 years. But hey, there's something in the news this week that's quite popular with all of our European investors, more so. And we have this big, beautiful bill coming out of the United States. We know that Trump and Elon Musk's bromance is all but over. They've been fighting on their respective social media platforms. But what's this big, beautiful bill? How does it impact us as European dividend investors?
Well, first of all, I like the acronym BBB. Yeah. So just like the new credit rating of the US in a year from now. But I think if that happens, some of our holdings will be having an issue, because that would mean that the interest rates of the US bonds, the 10-year treasury yield, would go up. And that means that our real estate investment trusts share prices will probably go down, because, they borrow money and it's often derived from that. So, let's hope that it doesn't get that far. But look, really long story short, what they have in this bill is saying, like, for those countries that are not so friendly to the United States, they are introducing some kind of revenge tax. And if you pay now, and so generally we pay a 30% dividend yield, 30% tax rate on dividends to the US, but then we have this, this tax treaty, which our brokers typically deduct automatically, and therefore we only pay 15%. What they are saying is like that every year there will come 5% on top of that, up to 20% there. So your 15% after 4 years, so in 2029, let's say, or 2030 could be 35% of tax that we are obliged to pay to the US. So there's a lot of concern, I think, around the community, or a lot of curiosity, let's call it like that. I don't know if they are concerned about what to do. Does the US become uninvestable? I cannot predict into the future. My holdings are still the majority in the US, 55% or something like that. So the other 45% is elsewhere. And it will become more European-like, right, when it comes to the tax burden then. So we had Tim Ailey talking about this. Lucian reached out. Hans de Jong, also Tadeusz reached out. Is there, and it's really like, will we sell American stocks? Are we changing the strategy? Tadeusz thinking that if that becomes a reality, his current strategy, DGI, does not make any sense anymore. First of all, I think it was Taco, right? How they called Trump.
Yeah.
So Chicken Out was the CEO, right? So
yeah.
So that first we need to see coming in action. I think what the Americans don't like is that we have this digital tax and such on some of the tech stocks. I don't understand sometimes why the Americans don't like it. They feel like we're doing unfair taxing or something like that. But come on, if you don't pay tax in the country where you have I would say it, where you have revenues through some tax loopholes, I think it's fine for the European Union to close those loopholes. And if they can't close it directly, you close it via another way, right? So I don't personally. I think it's more about fairness there. But let's take that aside, because it becomes quickly political. First of all, I would like to see it happen. I think it's also a negotiation technique. But so how I can envision it work. One scenario might be that therefore the US stocks get repriced, share prices go down, yields go up. So in the end, we still get the same net dividend income somehow.
Yeah.
Because the US depends a lot on foreign capital. So if people start to sell there, you will see the yields shooting up, right? More to more reasonable prices. But then also the tax after yield, I guess, or the net dividend that we will get may be similar. So I think there are some options that may all, like, when it comes into action actually, and in some cases even neutral for us there, because not for your existing portfolio, but for buying new shares, I would say.
Yeah.
Because I can't imagine that share prices would continue to grow if this starts to happen, that in Europe massively retail investors and investment funds start selling stocks. Secondly, what would you reinvest it in? I still think that the US has the best opportunity when it comes to the availability of dividend stocks. Yeah, in European, you and I are doing a lot of effort to expose our friends in Europe to available dividend stocks. And we have, I think, already exposed more than 150, 200 to the community over the years, maybe even more. So there's enough alternative. But if you think about the innovative quality, I would still like to have a large part of my portfolio in the US. So then it comes down to, are you going for growth investing? Yeah, for those stocks that pay no dividends, or where you don't care really about the dividend. Yeah, that would be a hard one for me, because that I would need to rewire my whole brains into the investment philosophy, and one thing I'm not good at is selling stocks, knowing when to sell. So that's why I like dividend growth investing so much. So in the end, I think the first 5% I will just take on the chin and see how it plays out. I'm actually more concerned about Europe and their tax laws via the wealth tax that they are everywhere introducing than the US, to be fair.
Yeah, it depends. I mean, there's no hard figure like it's between 35 and 50%. So I think for sure if it was 50%, it would be uninvestable for me in the United States. 50% it's a big dividend cut on my existing portfolio. Let's put it this way, and it pushes back your projected annual dividend income. Your paddy goes right back as well. The problem is, like you, half my portfolio is in US stocks. If I was to sell, it would be a big capital gains bill. You have that kind of issue there. But if it jumped up to 50%, I don't think I would invest any future. I don't think I would sell to offset the tax, but I think any future investments would be more tailored to
but
European
I can't
companies.
see that the US would continue doing that, because it means just that the US becomes uninvestable for many of those companies. And I can't imagine that this, America, the country of capitalism, I can't imagine that they will sustain that. I think there will be a lot of political backlash. I think also the next president will take it away again, because they will just lose out on a lot of capital, and they need this. I also could imagine that the dollar further weakens. Yeah, so interest rates going up. I think they're really playing with fire. So let's see if it comes to fruition. But we have 3-4 years to observe becoming to that rate according to the bill that they're introducing. So we have some time.
But like you said, if he does do it, and it's a short-term thing, because Trump is 3.5 years left in term.
Yeah.
So if it was 3.5 years, share prices come back down to a more reasonable level. Yeah. If you're playing the long game and you think eventually whoever comes in will come to their senses and go back to normal, it could present a huge buying opportunity in terms of getting really good companies at reasonable prices, and then you'll benefit. But then that's a gamble; it's a risk. You don't know.
Yeah, but everything is a gamble. I mean, the one thing is for sure now, America is not anymore a trustworthy country from an investment point of view and such, and all this everything that's happening geopolitical that just changed over the last year. Yeah. So, and I think that comes with a risk premium. That's why the interest rates are probably also a little bit higher. And we have some beautiful European companies to use this words, the big beautiful bill. So we have a few big beautiful companies here. But politics just doesn't help at all, because also those European companies often really depend on the US market.
Yeah.
So
and capital. Yeah.
Actually, exactly. So I just wish that we went back to normal and keep Europe and America close with each other. Don't fiddle too much with all these capital processes like tax and everything, and just move on, guys. Just move on. Just keep your head cool.
I wonder how the shareholders of Tesla are feeling right now.
Because I'm not a shareholder, so I couldn't care too much about it.
Yeah, but I mean, for a long time, it's been seen as a safe investment. But it's going to be bumpy. I think they're in for a bumpy car ride.
Yeah. It's. I mean, there will be enough books written about this whole period right now in the future. I'm quite sure of that, and I just hope that nothing bad happens in America in the sense of civil unrest or something like that, because the last thing that we need.
Yeah. Okay, let's move on to more positive news, and we'll talk about dividend hikes. And there's two of note. The first one, I don't know if you're surprised to see this or not, but United Healthcare Group, despite their troubles, despite the share price dropping off the face of the earth over the last couple of weeks, it hiked its dividend by 5.2%, which is decent, but it's low by their own historical averages. And we've got Lowe's, ticker symbol LOW, raised its dividend by 4%. But what are your thoughts on United Healthcare?
Yeah, we spoke a few times about it in the last podcast, right? So I have no feeling really for this company. Again, I sound like a broken record. I don't understand why people would even pay for healthcare in the US. So 5.2%. I mean, it signals that also from management, if they are breaking with the historical trend, that it's more difficult for them at the moment. That's more how I see this. And yeah, for the rest, I wish all the investors luck there. I think there were a few people that bought around $250, $260. They may feel good now because it's around 300, I believe. Let's hope that it was a dip and not that it will get back there and go further down. I mean, the company is not a business. I mean, for me, it's a sin stock, pretty much like tobacco, but it's not priced as tobacco.
Yeah. Nice. Okay, so today's main topic comes from David, and he left us a note on one of the social media platforms, and it is the following. So he wrote, I'd love for you to cover a podcast episode exploring minimum starting dividend yields, dividend growth rates, and annual investment amounts for dividend growth investing. This includes European DJI specific rules and criteria. I know it's not an exact science and can vary, but general insights would be valuable. So there's two perspectives that he has. One, he is a retiree living off dividends, invested from the proceeds of selling a business, okay? But he also has a 36-year-old son who aims to retire in the next 20 to 25 years and is seeking a little bit of guidance. So we've got two kind of perspectives and how we manage and explore starting dividend yields, growth rates, and all that fun stuff. So what are your thoughts on this? I know you had a calculator and you shared this before, and you have.
Yeah, so I'll share it also in the show notes of the podcast. But David, we have a calculator, or I have a calculator on European DJI, and actually you can plug everything in there. So you can plug in what your monthly expenses are on average, the growth rate of the expenses, so that you know how this line will evolve. But then also like what your starting investment is, how much you're monthly able to contribute, or quarterly or yearly, what your yearly capital appreciation expectation is, inflation, so average yield on cost upon investment, and that's something that we will speak soon about, but also the average annual dividend increase, and then the annual dividend withholding tax rate. So I think all these parameters are important in everything here, but he's asking specifically for his 36-year-old son. I started when I was 31-ish or something like that, 32-ish, 33-ish, something. I don't forget, it goes so fast. But what I think is important to know, generally speaking, it's all about the compounding, right? Mm-hmm. And let's take a Microsoft yielding, I don't know if Microsoft, but let's say you invest in a company that is yielding 1.5% now, today. Yeah. And you estimate that it will grow 10% into infinity. Yeah.
Yeah.
And then we'll take also a scenario where we invest 3.25% starting yield, and it grows by 7% annually until infinity. If you take that alone, it will take about 50 years before there's a crossover point. Yeah, so that takes quite a lot of time. So I think it's really important to consider that. Now, if I'll model, let's say, with 3.25%, and what my assumptions are 6% annual dividend increase. If I use that, so 3.25% on investment, it will take me personally around 17 years to retire early. And if I would change this to 1.5% and a 10% yield, it would take me 22 years to retire in my case.
Yeah.
Yeah. So it shows you already like 1.5% and 10% takes you 5 additional years. Yeah. But of course, after that, the compounding goes much quicker. But now comes the difficult one, David. Which stock that you invest in 1.5% will be able to have a 10% compounded annual growth for 22 years? Yeah, and that's something that I find hard to imagine, even a Visa or something like that.
Yeah.
I mean, predicting today which stock will grow by that on just for 22 years, I just can't imagine that. And often the shares that are trading at 1.5% are not there because they necessarily have a very low payout ratio.
Yeah.
They're often just also heavily overvalued, where you pay a 30 or 35 PE. And that's why the yield is much lower. If they will be trading at a 15 PE, half of it, they will be 3% yield. Yeah. So I think this is something where I always look at value, at valuation as well, because I don't want to overpay for it. And there's a lot of growth expected into it. And there are some, you'll find it online. There's some reverted or inverted discounted cash flow calculators where you plug in what the cash flow today is, what the share price is, and it will tell you what the expected growth is over all those years. So, and that makes it so hard. And that's why, let's say, from the whole stock universe of thousands and thousands of stocks, there are usually only like a handful each month that are attractive to invest in, that give you this nice combination of starting yield, growth, valuation, and quality on the balance sheet and such.
Yeah.
And I think this makes it so difficult, but that's why I model with 3.25%, because it really allows me also to to play with it, with low yield, high growth, with high yield. For instance, you can take a higher yielder, like, I don't know, one of the insurers in Europe for 6-7%, and then you can buy a Microsoft for 1.5% at a reasonable price if you think about that.
Yeah.
And I think that's just the way I do it, which allows me to have a little bit of both in there. But generally speaking, I don't like to go below 2.75% as a I said rule of thumb.
Rule of thumb. Yeah. Yeah. It's a balancing act, isn't it? It depends, first of all, on how much you have to invest and what your expected outcome of that would be. How much do you need to live off? It can work if you have a lot of capital to invest in, and in a 1.5 yielding company, if you're only expecting, say, maybe 20,000 or something, it can work. But if over the long term, if you're investing maybe 1,000 a month, 1,500 a month, that becomes a lot harder, as you said, because it'll take a lot more time. But for me, it's always a balancing act between quality, which is what you would associate with these companies with high PE ratios, and dividend yield and dividend growth. So it's a little bit of a balancing act, and that's why it is so tricky to know. And there's no one size fits all answer here, because everyone's timelines and horizons are different. But with a 25-year horizon, you can definitely lower your starting yield to around 2%, maybe 2.5%, and focus on those companies that have dividend growth rates at around 8%.
Okay, so let's model with that. I'm having my calculator open.
Yeah.
What is your expected average annual dividend increase that is reasonable for a well-diversified portfolio, having a little bit more in US stocks, let's say 65%, and the rest in European?
Let's say 5.5%, 6%.
6%?
Yeah.
Okay. What is your average yield for 25 years, do you think? What average yield would you need?
Let's go 2.75.
Okay, so if I plug that in and we think about yearly inflation of 2%,
Yeah.
okay.
Keep it.
So if if I'm able to, let's say, save 40% to 35% of my monthly income, and I assume I have salary growth of, let's say, 4 or 5% as well, so I will be quite quickly at a 50% savings rate, right?
Yep.
So if I assume that, and we said 2.75%, 6% annual growth, it gives me 19 years, 90 to 20 years it will take to reach financial independence, the cutoff rate.
Which is nearly bang on what his son is looking to achieve.
Yeah. So if he goes to 3.25%, it would be 7%. And if we go to 2.5%, it would take 21 years. So, and if we take 2%, it would take 24 years. So he can lower his starting yield even to 2% if he wants it to be in 25 years. So he will be 61 then, and he should be able to live off dividends if he can save nearly half, let's say, of his salary relatively quick. That's I think important.
Yeah, it's quite interesting, isn't it? So like we're talking about yields, starting yields, dividend growth, but the savings rate is also something it's
the most important,
really
I would say. The savings rate is probably for the majority of the time the most important.
Yeah, and often overlooked, I would say.
Yeah, exactly. And the savings rate you have a lot of control over. Yeah, except for the exceptional life events. But generally speaking, you decide how much you want to save. There are usually a lot of options to save on expenses. Yeah, it's a lifestyle question. And secondly, if you just make sure you're working in an industry where salary raises are above inflation because the businesses grow above inflation, then I mean, it should be possible at a certain moment to really do that. Yeah, because if you go to work for a ministry somewhere in the public office, don't expect your salary to grow above inflation. You need to have exceptional performance. But in the typical ministry, you make a promotion when someone dies above you or retires. Yeah, but if you go into IT or an AI company, pharma, yeah, then typically it does quite well. Those are industries that grow above inflation. So you don't need to be the smartest there to earn money. You just need to get in.
Yeah. So it's quite important to pick a career path where you can live off 50% of your annual salary. That's
yeah. But also thinking about what lifestyle. I think what is hard today, I think, because of the last 10 years, the housing prices exploded. So if I would start out today, I think I would. It would not be easy to get to 50% quickly. But also, I mean, I only started to save when I was 30 or something like that. Yeah, not in my 20s. Everything went to the mortgage. I had to save for a vacation, and now I can do almost everything out of pocket.
Yeah,
because I avoided lifestyle inflation as such. So I think that's also important. Generally, how you sit in life. But if you're 36 and you come after a divorce or something like that, yeah, then it's usually not easy to. Your expenses are probably high, alimentation if you're a man. So it really depends a lot on those. So also investing in your relationship, investing in your wife also pays dividends, I would say.
saves it protects your wealth.
Yeah, it protects your wealth. Yeah, exactly. Yeah, but all these things matter. Yeah, it's not just only about the starting yield and the portfolio growth. It's also the life decisions you make that allow you to have a good savings rate or not.
Yeah, I mean, that's a good point because you can look at all the numbers on a spreadsheet and that's all they are. It's just numbers on a spreadsheet and you can tailor them to match your expected outcome.
Yeah.
But sometimes life will get in the way and life will have its own ideas and direct you down a different path. So you can't just plug in numbers and think, yes, I'm definitely going to reach this in 20 years because you don't know what will happen. along the way. But yeah, you have to try and control expenses, your lifestyle. What do you really want? Do you want to live more today, or do you want to have more money in retirement later? And it's definitely a balancing act, definitely for me anyway.
But what are some things that, for instance, you don't spend a lot of money on compared to maybe others around you, but you feel like very, very happy with what it gives you?
Yeah, I mean, I don't like. I spend my money on very, very few things. Coffee is probably one of my biggest expenses because I'm constantly traveling around the road at matches. So coffees, lunches are my biggest expenses. I don't have many subscriptions. I don't watch TV a whole lot, so I keep my costs relatively low, I would say. And even coffees, sometimes I bring my own flask, my own tea. But I've tracked, I think over the last year, maybe 18 months, I've tracked every single penny that I was spending. And one thing I noticed, for example, was that I was spending a lot of money in work on lunches.
Yeah.
And to be honest, I didn't even really like their lunches. It's not the best. So I've cut back on that. That gives you a saving. So,
but how do you cut back on it? Are you preparing your own meals then and taking them to work?
Yeah.
Because I usually don't have time for that. And that's why I do spend quite a lot of money on lunches as well. But I see this as an investment that comes with the job that I have. I see it more like a cost to be able to perform my job, because otherwise I would need to cut back on time related to my work, and I think that this may hinder me somehow in my career.
It's quite simple for me. When I make dinner, I make an extra portion that I can just put in my lunch. So whatever I have for dinner the night before, I'm having a smaller portion of that for my lunch the day after.
So I do it sometimes that I cook on Sunday, but during the week and after work, I usually don't have time to cook because with kids and everything, we have a lot to do.
Yeah.
And in Poland, you eat during the day. And in the evening, you just eat a sandwich. So it's also a little bit different organized.
Yeah.
But that's one that I felt like I'm not cutting down on. But if I can, I would. Yeah. But for me, for instance, vacations. Many people like to go on all inclusive, but I just love to go camping with the kids. Just very simple. And the kids are on the campsite all day in Croatia somehow, and beautiful locations, those campsites, great facilities. And I would say they come at a 30-40% discount to an all-inclusive somewhere within Spain.
Easy.
And I get much more joy out of it, camping. It gives me more mobility as well to travel around the coast there, to go for some day trips. Yeah.
Yeah, I kind of envy you guys on the continent a little bit, because we do camp when we stay within Ireland. We do camp, but the weather's not always in cooperation with what we want. So sometimes it can be quite a miserable experience in terms of if it's raining all weekend when you're putting up the tent, when you're putting down the tent. I don't mind so much raining when everything is done and you're in the moment, because you can put up with that. But I hate taking down a tent when it's raining. You're wet, the tent's wet, it gets moldy, you have to fix all that. But I have to travel by plane to the continent, whereas you can drive. True. So you can pack all your camping gear, you can do all that. It's a little bit more difficult for me. So I need to either rent all that stuff, which is an additional cost, or just go on an all-inclusive holiday, which is what I've booked for this July. So
no. Another one that I think you and I both do, I buy a new car like once in 10-12 years.
Yeah.
So I save so much money on that, and I really don't care about my neighbors thinking about my car.
Yeah,
I really don't care. I mean, they need to look at it, not me. I sit in the inside. So as long as the inside drives well, I don't care what people... Yeah, because also in traffic jam, I don't see my own car. It's others seeing it. So why would I care?
Yeah, exactly. I'm going to see the same thing in a new car as I see in my own car. A steering wheel in a road.
Exactly. But I love it when when my neighbors buy a big car, because when I watch out of the window, I can see it. And when I'm in a traffic jam, I enjoy someone else's Porsche. Yeah.
I'm quite similar. Like, I have no meaningful mass on cars. I don't care what I drive. Just once it gets me from A to B safely, that's all I care about.
So next time when I see a Porsche or something like that, I will lower the window and I will say to the guy, thank you. Thank you for giving me this joy. You can't see what I'm seeing, but you're subsidizing my joy of cars. And
But apologize that he has to look
Yeah.
at your car. Say, I'm sorry.
Yeah, exactly. Exactly. Yeah. But then I'm saying like, well, I will be financially independent in 2 years. So, and he's still paying off the car.
Yeah. I mean, we were looking, because you know this, I'm on the road pretty much every weekend with football, because my guys are now playing League of Ireland level. So it means I'm traveling the length, the breadth of Ireland every Saturday and now every Sunday, because my 2 kids are playing. And we were looking to say, right, we have a car, it's decent, it's good, but will we invest in a bigger car that feels safer on the road? And when we went looking at prices, like, so the minimum was about 60,000. I'm like, I'm not paying 60,000 for a car. It's crazy. Like, how are all these people financed? Like
Leasing and everything, and because I think many people, and I had the same in my 20s. Yeah, you think about at that time, maybe okay, I get like, I don't know, €1,500 net on my account. I don't know, 500 went to the mortgage, then this, and then that. And you think like a certain, so I can spend €300 or €400 on a car per month. And those, I don't know what it is today, right? But those lease payments are really targeting the middle class like that. So that you are just taking a certain percentage of your salary to that. And when the lease ends, you think like, I got I don't know, over time, 10% more salary. So instead of €400, I can make it now, I don't know, €450. So I can own a bigger car.
Yeah.
So but you're just really filling up this bucket all the time with leasing, and you know that the company is owned by the lease companies, so they need to make a profit on it, and they make a profit on you, on your behavior. They make it easier for you in return to hand it in again, and maybe the all risk insurance, whatever comes with it. I don't know how that exactly works, but if you just own your car, and
I pay once. I mean, they have this really clever program over here called PHP, I think it's called. I might have got the acronym wrong, but it's something like that. But it's really clever. So it lowers your monthly payments. So you pay a deposit up front. Let's say it's a 60,000 car. You might pay a deposit of 10,000. You then pay a lower amount over 5 years to half the value of the car, or maybe 60% the value of the car. And then at the end, you have a choice. You can pay the balance yourself. So you have to pay 20,000. Or you can upgrade and go back into another PCP, you can go into another PCP agreement, and you're locked in again. You pay another deposit, or they use your car as a deposit, and you're just paying monthly payments. So they're just locking you into this wheel. And it's really, really, really difficult to get out of it, because in order to get out of it, most middle-class people are not going to be able to stump up 40, 50 grand. So they end up taking a loan if they want to do that. They don't want the loan.
I never had a loan yet for a car in my life, but that was because my first job, I got a car from the company.
Oh, nice.
And after that, I was able to buy a car myself, and I just bought it cash. So I never had a loan on the.
I tell you, I did. I was earning way too much money as an electrician when I was 20 years of age. So the boom in Ireland, everybody knows the boom in Ireland. You were making money just by walking down the street and looking at some cables. I was earning money, but I went out and on finance bought a Land Rover, right? A big, massive car. I mean, I looked like a baby driving this. I didn't have a beard. I looked really young. Like, people were looking at me going, "You're too young to be driving this car." But it was so expensive. But then I remember when the great financial crash happened. It was 2 years into the 5 years of that. I was no longer making the same money. And I still had to pay that. And that experience taught me I am never going on finance, because it was those 3 years were torture to try to pay it off, because I was nearly paying that off before feeding myself sometimes.
Wow.
Because you had to pay it. So, and then fortunately I got rid of it. Then we started a family. So it was a good learning lesson for me, I have to say.
Yeah. So for me, but you know, having this kind of, is it frugal? Maybe a bit frugal side, not having lifestyle inflation, let's say. I just drive a simple Hyundai middle-class car. My salary has been growing really nicely over the last 10 years, let's say. Just allows me to have a 50 to 60% savings rate. And I really enjoy everything I'm doing. But I don't pay interest to anyone, at least except for a small piece of mortgage yet, which I could have paid down, but I decided not to do. So I don't own anyone I kind of have a AAA balance sheet at home, and
Yeah.
if something happens, I can pay it out of cash. And it does mean that you, in your, for me, it was at least in my early 30s, that you need to do some delayed gratification. I didn't get money from inherited, nothing from parents. It's all earned by myself. You know my story. I come actually out of poverty, so yeah, I just don't know if the current mid 20-year-olds have the same opportunity. And I can tell you, it was not easy for me either. It was already tough, but I think it's much tougher now, even with the housing prices. That's the only concern that I have. Other than that, I think it should all be possible.
Yeah, I wonder if I was back in my early 20s now, would I even bother trying to buy a house? Why try and break yourself just to own?
But then you would need to rent it, and someone wants to earn on their real estate as well, so they need a yield as well. So in the end, you still end up paying a lot.
You're paying a lot of rent, but you can do that now. You don't have to like try and save. So in Ireland, you have to save 10%. The average house price is
true
400,000. So you have to have 40,000 before they even consider you.
Yeah, and if you can only save 100, 250 euro per month, you won't get far.
Exactly.
Yeah, that's a big issue. And then you end up probably renting with roommates to split the bill.
Or buying a camper van and living in a camper van.
So David, we went a bit off track talking more about expenses and everything, but I think it's an important topic to not only look at the starting yield and such. I think Derek and I truly believe that the savings rate is even more important sometimes than your starting yield and annual dividend growth, because that's really where, specifically the first 5 to 10 years, you can make a huge impact when it comes to your portfolio and your dividend income.
Nice. So we've answered some listeners' questions already with the big, beautiful bill, but we've got plenty more. So we'll go to an email that we received from Fabian first. Really interesting question. So you've got 3 companies. We're going to call them company A, B, and C. They are identical except for their balance sheets and their market caps. Okay. So company A has no debt, has no net cash either, and has a market cap of 10 billion. Company B has 2 billion of net debt, market cap is 8 billion, and then company C has 2 billion of net cash, but has a market cap of 12 billion. Which company would you prefer to own and why?
Yeah, it's a hard one to answer, but I think I would go for company C.
Okay.
I like cash-rich companies. It gives them flexibility, optionality. They can buy a company. Of course, in all of these, you need to understand the return on investment, which is not a given here, but all else being equal, and probably it has all the same outcome mathematically, I would still opt for company C, because somehow it's been able to save cash that's on the balance sheet. So probably it's a more asset-light business. That's my assumption. And maybe therefore worth to pay a little bit more for it. And this cash can compound. And on company B, they have 2 billion in net debt. You are paying interest rates, which is taking future profits away from you. So I would go for company C.
Yeah, it's funny. It depends on what hat you look at these 3 companies at. Because if you look at company A, it's probably the cleanest, most straightforward company. You basically get what you pay for. That there's no tricks. There's nothing there. Company B has a little bit more debt, but it's cheaper than the other companies. And if you look at metrics such as return on equity, you're going to get a higher return on your equity on this company. And then, as you said, company C probably has a stronger balance sheet of all 3. I would lean probably towards company C as well, but it's 50-50 between them and company A. So I prefer to keep it clean and straightforward. I know what I'm getting. So yeah, company, it's 50-50 company C or company A, but it's definitely an interesting question depending on your overall perspective. TJ has asked us, in the last show, we talked about asset-light companies and how their margins are often higher than asset-heavy companies. But also we mentioned that it can be harder to find a moat in them. Can you talk more about that? Do you have a preference for one style over the other?
Yes, that's so generally I like asset light companies because they usually have more flexibility, and but indeed it can be harder to find a mode. So how to talk about it? I thought we spoke quite a bit about it, but for instance, I don't like utilities. It requires a lot of capex, really a lot of capex, and therefore they're usually debt heavy, but they have low growth profiles, and also therefore they are probably debt heavy. But how easily can you enter a market as a new utility? Yeah, everyone can start a software company, which is asset light, but with having a software company, if you really solve a problem for companies, you can create a lock-in again, and therefore maybe create more of a moat as well until the next technology comes in. I do prefer some assets. I guess it's probably more in the middle, like Unilever. Yeah, with that scale, with the brands, the supply chain, there's a lot of moat in that. You cannot just challenge Unilever and ceases to exist tomorrow because you have a better product. Think about software. Today you have this reporting tool, and tomorrow comes an AI-driven reporting tool, and there's not really lock-in with the company, with the clients, and you just switch, because switching costs are low. I think that Unilever is more of an example that has some moat, and the moat is also in its diversity, in the brand power, supply chain, and therefore it's hard to just compete with them. You can compete on an individual brand here and there, but it's not easy to start a company and just create 20 different brands for different products and compete the hell out of Unilever.
Yeah, but I mean, we talk about moat, but really what you have to look at is, do they have a competitive advantage? And if you take someone like the London Stock Exchange Group, so their main subscription-based service is based on financial data. There's other companies that can do that, but that doesn't mean that they'll be able to do it as well or as good as London Stock Exchange, since they bought out Refinitiv. So, I mean, yeah, you might not have as much moat, but I'm confident in someone like the London Stock Exchange Group being here in 15 years' time and still offering high-class data solutions to our exchanges, to interact with brokers and such, and make decent margins. So, yeah, I think it depends. I don't focus solely on moat, but more so on what competitive advantage that particular company has. But to answer the question directly, I think I prefer asset-light companies a little bit more, because the free cash flow, your operational cash flow, they can use it a lot more easier to grow and scale the company, but also to reward us as shareholders. So
same here.
That's my opinion. Mark has asked us about how to know when a stock company valuation has peaked and it may be appropriate to take some profits instead of holding for zero dividend growth.
Well, you just wait 3-4 years and you check the price chart, and if it is lower than then, it peaked.
I mean, I guess I get what Andrew was saying, but I've been burnt on this a couple of times before. Microsoft ADP is another one that I bought when I thought they were overpriced, and then what happens? They just grow into their earnings and they just explode in their share price as well. So I think it's more around your growth profile of the company. Do you think that there's no growth in them at all in terms of the share price, or no share price? What's the future 5 years look like? And take it from them. But I don't know. All I can say is, when I've sold based on what I thought might be a high valuation, I've been wrong every time.
Yeah. So for me, it's one of the hardest things to do. That's why I rather wait for a dividend cut, because it makes it easy.
Yeah. We got a question then from Andrew, directing this one to you, European DJI, as you're closer to financial independence. When you quit the day job, which areas of investing do you see yourself putting more of your free time into?
It would be just dividend growth investing. I wouldn't see a reason why I would do something different.
So he's asked, would you look at other markets, maybe the Asian market, the rest of the world market? No,
actually not. I mean, it never came to my mind. If I think about anything of investing, and I would have, let's say, my dividend growth would start growing further than I need my expenses, let's say 4 or 5 years down the road, I might rather think about investing in local companies or something like that. Yeah, maybe there's a really great coffee store that I like that is growing, and I think like, let's get in contact with the owner of it. Maybe we can make it a franchise or something like that. I would rather think like that there, but maybe some real estate, like an apartment, because then I would have time to look after the tenants and everything. But again, there's nothing really interesting in my environment from a pricing point of view, because the yields on real estates are very, very low when you think about the rent.
Yeah.
But generally, I wouldn't know why I would switch or change my style or start investing, for instance, in growth stocks. I think the issue is it would require me to learn all of that, and I'm not sure if I'm looking forward to that. If anything, I would like to just further continue building out our dividend premium service and scale it, that over time more and more Europeans have all access to this. I think that's where really my passion is, and then I can just spend more time on it than I do today. I would still probably be busy 20, 30 hours a week, because what then? The world around me is working and I'm just with my legs all the time up in the air. No, I don't see that. I will probably just, I won't have the stress anymore. That's what I would like to have.
I can see you up on a stage or doing one of those TED Talks. That's what I can see.
Yeah, maybe such things. Maybe I feel comfortable by that time to be public and do something like that. That would be awesome.
Nice question. Hans has asked for dividend-paying companies in emerging markets. What countries would you consider safer investing in? Okay, so he's looking at Kaspi from Kazakhstan and also a Mexican airport. I think the ticker symbol is ASR.
I actually wouldn't know, Derek. I haven't given this thought a lot of chance or a lot of time. I would be curious about India.
Yeah.
But just because it's a growing market, I feel it has a reasonable, friendly to other countries' policy making. Let's say I don't know how open it is, but I would need to study more about India. But that could be something interesting for me.
Yeah, me and Dazzy Mike touched on this briefly when we were discussing unknown hidden gems, and I think our kind of outcome was it's risky in areas that you're not really living in. So say somewhere like Mexico, I don't get the Mexican news, so I don't really understand what's going on in that country. The same in Kazakhstan. And we have that problem even in Europe in terms of a Romanian company. All my news is tailored to Western Europe. So it's quite difficult to get that news ready to you unless you go looking for it. And even at that, then you don't know whether you can trust the source or not. So I always find it risky with emerging markets. I would much prefer to go into an ETF or an investment fund where you have a manager who has experience in that area and let them manage it for me. That would be my preferred route to go. Jan has asked us to pick 3 stocks for a newborn. And the earliest it can be sold is 18 years. So we've got an 18-year horizon. We're not allowed to pick any European insurers. Okay, one company has to be high yielding, over 7%. One medium yield with moderate growth rate, and then one high with one low dividend yield with high dividend growth rate.
Well, the high yield is a bit difficult, but let's say the low yield, I would take Microsoft.
Okay.
Medium yield would be Iberdrola, the Spanish energy company. The high yield, maybe Legal and General.
Okay.
No European. But is the UK European?
Technically it's not.
Yeah, I find it hard because I can't quickly think of a lot of high yielders at the moment.
Enbridge, tobacco stocks.
Maybe I would buy some more CBUS, but I don't know if they're 7% yield now or 6 something.
Yes. So low yield, I go with ASML or Novo Nordisk. Maybe Novo Nordisk. Medium yield, Johnson & Johnson. And high yield, 18 years high yield. I would probably go with someone like Rubis in France. That's what I would probably pick. El Cuba, what is the best stock bought before your first episode of this podcast, and do you still keep it?
So let me check. Let me say one of the first stocks I ever bought. Let's go for that. A lot I don't own anymore. See, Microsoft. I bought Microsoft for $43 on the 2nd January of 2015. No, for $42.20.
Wow, nice. Before I started this podcast, one that I like is Glanbia. I bought them. They were actually my first ever company, and I still hold them. I did sell them, but I bought back into them, so I still like them.
I'm going through my transactions and Tupperware pops up again. It's nice that it sometimes reminds me of my foolishness.
Tupperware parties. And then the last question of the day goes to Stock Junkie. Which Belgian stocks would you consider in your portfolio?
Nothing that comes to mind at the moment. Maybe Van der Velde, just because I like their annual report.
I know you don't like banks, but you've got KBC Bank, but you also got their holding company, which is a pure play on, they just basically receive dividends from KBC, but I think it's KBC and Cora, ticker symbol KBCA. I know you're not into banks, but this one seems quite popular in our, with our premium subscribers. Actually, there's a few people talking about this.
Nice.
Not my favorite in terms of dividend growth profile, but seems quite popular. And that is it. Yeah, that's the last question. Thanks as always to everyone for asking questions. Please, if you're listening to this and you stuck around this long, please take a couple of more moments to leave us a review, maybe like this or subscribe, depending on where you are listening or watching. And we will see you all next week.